He's very excitable. Don't say anything to him. Zone 5.
Ed Johnson from Park City, Utah. As you receive the proceeds of the Class B sale and generate other cash, are you seeing opportunities out in the marketplace to continue to provide the kinds of returns that we've been fortunate enough to experience in the past?
With or without the sale of the B, we don't see things to do that can maintain anything close to the average returns of the past. We've tried to convey that, and it becomes a mathematical absurdity. Money just won't compound at that rate in this world, absent extraordinary inflation. Certainly won't compound in real terms. So, absent the issue of the B, we are not looking at things. We're not seeing things. We're not hoping to find things that match some of the things that we have found in the past relative to the capital base we've had in the past. But we have that problem with or without the B, and it has not changed in any very minor degree by the issuance of the B. We are looking for things all of the time. Anytime we find anything that makes sense to us, we will do it. The harder part is to make sure that we don't do something when we don't find something that makes sense. I mean, that's the bigger worry. And when we find them, they'll come along, and you never know when it's going to happen. We run into businesses. I described a little bit of that in the annual report, almost by accident. We've had contracted to make one purchase this year. The people who run it are here today, and it came about because I was attending a birthday party, and I'll go to more in the future. So things have not ended around here. We'll find interesting things to do over time, but they can't remotely be as profitable as the things we found in the past, simply because of the large capital base. Zone 6.
Hi, I'm Matt Zuckerman from Miami. I don't know, I think Charlie is the same class as Ev Dirksen. $3 billion, we'll soon be talking about real money.
Yeah.
The two questions I have basically are one. Number one, referring to the gentleman over here before who commented on your popularity, which will definitely affect the stock, don't you think, and the second part of that is that even my wife's beautician has put in for some shares of the stock, and he represents a small tip of a large group who are probably doing the same thing on the one hand, so that there's going to be a large popular demand for the stock, which probably is not reflected in the numbers that the selling brokers are getting from institutions. And number two, mutual funds themselves, in order to lend some panache or glamour or whatever to their portfolios, will certainly be sucking up Berkshire stock after this. And have you taken all of this into consideration when you decided upon the number of shares that you're sending out, number one? And number two, that the reaction, at least in the first 14 days of the public to the shares, which will probably be in the range of $1,100, might not send the B shares up high enough to make a very, very interesting spike in the price of the A stock.
Well, we've considered what you're talking about. I think that the issue has been well enough publicized that the demand will largely be reflected on the books of the underwriter in a day or two. And I see no reason at all for a spike in the stock. I mean, the way we've designed it should really prevent that. And we tell people not to expect it. If any institution wants to buy it, if any individual wants to buy it, they're going to have a chance to do it. And I don't see any reason why there should be some huge influx of people immediately subsequent to the offering that didn't hear about it during the offering period. It's interesting. I think most of the demand will be retail and smaller holdings, not so much institutional. Most new offerings are done in a manner where the idea is to have far more demand than supply, and therefore cause people to maybe order stock they didn't even want, and just on the idea that this restricted supply will cause a big jump the first day. Whether you've seen Yahoo or a number of other offerings. Personally, like that sort of distribution arrangement, because you'll find that 30 to 40% of the issue will perhaps trade the first day. Well, I think, and perhaps at a lot higher price. I think there's something a little wrong with that kind of an offering, because the company obviously isn't getting proceeds that are equivalent to what people are willing to pay, and favored customers get the chance to flip the stock and really are getting paid an exorbitant underwriting fee themselves, even though they're called purchasers, because they sell it the first day. We will be very interested in seeing the volume in the B stock the first couple of days relative to the amount of the issuance. And I will be disappointed and I'll be surprised if the trading volume in the B stock the first couple of days related to whatever the size of the issue is turns out to be anywhere near as high as with most new issues. I think that we will have a better success in finding people who really want to own it and who do not buy it to flip it, I think, by this method of distribution. But we'll have a test of that. We will see what happens on trading volume, and I invite you to look at the volume and compare it to the amount we issue, and then look at that relative to other new issues this year, and just see how successful we were in finding real investors rather than people who were buying it to sell it to somebody else the next day. Let's see, was that zone 6? I guess we go to zone 1. Maybe we can vote. Yeah, but I don't want to cut off. Charlie says maybe we can vote, but I want people to have their questions. No? It just encourages them when you do that. I want to be sure people get their questions answered on this. I don't want to prolong it beyond. If you feel your question has been 95% answered by an earlier question, I hope you'll skip asking it. But we do want to have people who have questions about it answered, because I can tell by commentary and letters I've received that some people have genuine concerns. Yes?
My name is Jan Anglin. I'm from Southern Indiana, and this is my first Berkshire meeting.
Good.
I did have a concern about the B shares that's less business and more, I guess it would be concerned with your and Mr. Munger's personal safety. I often see your picture in the newspaper, and I certainly don't mind seeing it on financial magazines, but now it's kind of like proliferating. I don't like the idea that you are so visible. That bothers me.
Yeah.
I mean, do you understand what I'm saying?
No, I understand exactly, right. Yeah, it's occurred to me. I appreciate that, but the answer is there's no other way. I mean, if over time, in terms of what happens, and as it grows, you get more visible, basically.
I know, but along with the B shares and things, can you kind of like be quotable but less available for photos?
No. Well, I normally am. If you've noticed, in terms of interviews or anything of the sort, I do not do them. I've been invited to go on all of the news shows, and I basically don't do it. Frankly, with the shareholders, I feel differently about this group. I'm delighted to see everybody come here, and I enjoy getting together with the shareholders. I think the real protection is if we'd done something that had caused the stock to balloon way up and then come way down, I might have had to be a little more careful.
I think she has a very good idea. Having seen that acting, I think hereafter maybe you should be the voice of Mickey Mouse.
I do appreciate the sentiment on it very much, and it is unavoidable to a fair degree, although Charlie may have thought I wasn't pushed into those acting jobs. Zone 2.
This is Joe Greer from Omaha, Nebraska, of all places. Regarding the conversion privilege, is there a time limit on the converting from the A to the B?
No, that's a good. I'm glad you asked that question. That's a good. The first 5 days or so after issuance of business days, there's no conversion. But after that, you'll be able to convert until Judgment Day. It's forever convertible from A to B, but it's not convertible from B to A. So there's no need to convert it until you have a reason to do so. And as I pointed out, there's a very slight disadvantage in converting it. Until I had a need, I would not convert it. Zone 3.
Scott Dowling from Redmond, Washington. Kind of related to this question. As an A shareholder, I can only see really two reasons to convert A shares into B shares, one of them being gifting reasons. In regards to that, how does one convert A shares into B?
Yeah. There are instructions on that in the proxy statement as to how that, I guess it's in the annual report too, that it describes how to do it. But basically you get in touch with the Bank of Boston to do that and proceed from there. Or if you have your shares with a broker, you would instruct your broker to do it. Zone 4.
Good morning. I'm Ruth O'Wades from San Francisco. I wondered, how did you decide that the ratio of the Bs should be 30-1 instead of 300-1 or something in between?
Yeah. We wanted to have something that was roughly would trade initially at least in the $1,000 range. We thought it very unlikely that anyone would find it commercially feasible to set up a trust that offered units that were denominated much below that. So that's as low as we felt we had to go. And we did not want to signal in any way that some sort of last chance or something like that to get in for some very low sum for people that just had some wishes that they could turn $100 into $100,000 or something. I get letters from people that think that somehow that can be done. It can't be done. And we don't want to appeal subliminally or any other way to people who harbor those hopes. I'm sympathetic with them, but we don't have the answer to that. So we went down to the level to match the unit trust. Zone 5. We'll try and end the questions on the B fairly soon, but I don't want anybody that feels that they've got some reservations about this not to have a shot at asking their question.
My name is Bob McClure. I live in Singapore. The way I figure it, the sale of the B shares at the price they will probably be sold will give an immediate boost to the book value of Berkshire Hathaway. So as far as I'm concerned, the more the merrier. Can you give us your thinking on that, the accounting treatment, how this will affect the book value of Berkshire?
Well, any shares we sell at the equivalent per A share of in the range of 33,000 or thereabouts where the stock is selling now will increase the book value per share, but that does not mean it increases the intrinsic value per share. I've said many times in the report, we use book value as a proxy in tracking movement of intrinsic value, but it does not represent anything like intrinsic value per share. And the key is not what it does to book value per share, but what it does to intrinsic value per share. And we believe the intrinsic value is materially higher than the book value. We don't spoil your fun by ever giving you a number, but we do not regard the fact that it increases the book value per share as being any kind of a determinant in deciding to issue the shares, but it will have that consequence mathematically. The key is the relation to intrinsic value. Zone 6.
There was a question over here.
Any questions in 6?
Your problem seems to be that you've attracted a fair number of potential shareholders that don't have a way of estimating intrinsic value or developing expectations about what Berkshire's future prospects are. Do you have any suggestions about how they might do that, short of the general guidance that you can't continue to compound your intrinsic value at the same high rate that you have in the past because of your asset base, and that you don't believe the share is undervalued?
Yeah, well, we'll probably talk more in the general question and answer period about our various businesses, but we simply try to give you all of the information about our businesses in a large general way that Charlie and I consider important and that we would want if our positions were reversed. I can assure you that if all Charlie and I knew about our businesses, what we publicly disclosed, it would not change our estimates from what they might be from being intimately involved with the businesses. The facts are out regarding what we do. So you are in the same position to the extent that you have followed our kind of businesses and understand industry conditions and all of that. And we'll continue to do that. We essentially regard you as our partners, and we try to tell you exactly what we as partners would want to know if you were running the place, and we'll continue to do that. We won't tell you a number because we don't know the number. We have a range in our mind. Things change that range over time, and we'd probably get in all kinds of trouble if we tried to put out that range. But and Charlie and I would not come up with exactly the same range, but they'd be pretty close. We'll talk more about that a little later. We do have questions now from Zone 7 and 8 in the other room, so we'll take on Zone 7, please.
I guess you've answered our questions in 7.
Took care of Zone 7. How about Zone 8?
No questions from Zone 8.
Well, okay. I think at this point we can move on to general questions after we have this vote, and then if you have another question or two that comes up during the general question and answer period, we'll be glad to work those in at that time. So we are now at the point. Is there a motion to adopt the Board of Directors' recommendation?
I move the adoption of the amendment to the 4th article of the restated certificate of incorporation as set forth in Exhibit A of the company's proxy statement for this meeting.
I second the motion.
A motion has been made and seconded to adopt the proposed amendment to the certificate of incorporation. It says here, is there any discussion? But I'm not going to say that. We are ready to act upon the motion. If there are any shareholders voting in person, they should now mark their ballot on the proposed amendment to the certificate of incorporation and allow the ballots to be delivered to the Inspector of Elections. Would the proxy holders please also submit to the Inspector of Elections a ballot on the proposed amendment, voting the proxies in accordance with the instructions they have received. Mr. Fitzsimmons, when you're ready, you may give your report.
My report is ready. The ballot of the proxy holders received through last Friday cast not less than 970,495 votes in favor of the proposed amendment. That number far exceeds the majority of the number of all shares outstanding. The certification required by Delaware law regarding the precise count of the votes, including the votes cast in person at this meeting, will be given to the Secretary to be placed with the minutes of this meeting.
Thank you, Mr. Fitzsimmons. The amendment to the certificate of incorporation as set forth in Exhibit A to the proxy statement for this meeting is approved. After adjournment of the business meeting, I will respond to questions that you may have that relate to the business of Berkshire but do not call for any action at this meeting. Anyone have any further business to come before this meeting before we adjourn? If not, I recognize Mr. Walter Scott, Jr. to place a motion before the meeting.
I move this meeting be adjourned.
I second the motion.
A motion to adjourn has been made and seconded. We will vote by voice. Is there any discussion? If not, all in favor say aye. All opposed say no. The meeting's adjourned. Now we'll move to to general questions, and we'll do it by the same zone system. As I said earlier, any of you are free, obviously, to leave at any time. We will break formally at noon and reconvene about 15 minutes later after you've all had a chance to buy a sandwich, and you can those in the other rooms can come in here, and we will go from then until about 3 o'clock. So we'll start in with Zone 1.
I'm Will Jacks from Chicago. I'm sort of representing Benjamin Graham today. The question he might ask. You talked earlier about about the value of your shares, the A shares, let's say, because the B is tied to the A. And I know I don't expect a complete answer, but generally, how would you go about placing a value on the A shares?
Yeah. Well, that's obviously a key question. As I've said, we try to give you the information. But I think people, to the extent they've made a mistake in the past in valuing Berkshire, and they have made this mistake over time, including many commentators, including some institutions, is to look at it as simply a breakup value to our businesses. I mean, you could do the same thing with General Electric, a magnificently run operation by Jack Welch. But I don't think the way you should look at a business like General Electric is to think about what would happen if they sold each division today, paid the taxes, and then distributed the proceeds. And that has tended to be the case with many people looking at Berkshire, looking at it on a static basis. And that is not the way that Charlie and I have looked at it over time. It lends itself a little more to that kind of analysis because we have a lot of money in marketable securities, but we have a lot of money in other things too. And the question of Berkshire in valuing the intrinsic value of any business, of course, is what is going to be the stream of cash over many years in the future. In fact, all of the years in the future, discounted back at an appropriate interest rate. I've talked about that in the past in the annual report. Berkshire is a collection of businesses, and some of which we own in their entirety, some of which we own part of. And some of those businesses have very interesting dynamics to them, and the value of our insurance business, for example, if you go back 28 years or so since 29, I guess, since we bought it from Jack Ringwalt, we paid $8.7 million, I believe, 8.7 million for two companies that Jack controlled. If you had the foresight at that time to, and I didn't, but if you had the foresight at that time to see what that would develop out of that insurance business, you would have come to the conclusion that their value to us was going to be far, far greater than the value at which they were then carried on our balance sheet. They were part of a business which had enormous potential. And that's been probably the most significant asset that's been developed at Berkshire. But right now we have over right at $7 billion, over $7 billion of float that's been developed from our insurance business. We couldn't foresee that 25 or 30 years ago, but it would have been a big mistake to think in terms of the book value of that business being representative of its actual value to us over time if it was run right. And that situation probably prevails today. So Berkshire is a group of, on balance, very fine businesses to which we hope to add. The intrinsic value will be affected by the job we do in allocating capital. It'll be affected by the job our managers do in running their businesses. It'll be affected by some items that we don't foresee now and perhaps have no control over. But it is not measured essentially by what we could sell each separate business for and pay the tax on now. We haven't run it that way. We've run it so that we get the use of a lot of capital at very low cost. Between deferred taxes and our insurance float, we have some $12 billion or so on the liability side that we think will be a very low cost, and that doesn't show as an asset, but it can be quite valuable. Charlie, you want to?
No, I don't think I've got anything to add to that.
No. I was all set to write it down, too. Zone 2, please.
Mr. Buffett, Mr. Munger, I'm Tim Medley from Jackson, Mississippi. My question is an allocation of capital one. You've indicated that one thing you like in companies is a willingness on the part of management to repurchase its own shares.
Right.
I wonder if you would talk for a minute about your own frame of reference on repurchases when it appears that the current price of the stock is rich in relation to its intrinsic value. And some have said that with the right company, ongoing repurchases of stock should be made irrespective of the price. So would you speak for a moment as to how you think it pencils out when the current price of the stock is rich in relation to its intrinsic value?
Yeah, if you're repurchasing shares above a rationally calculated intrinsic value, you are harming your shareholders. Just as if you issue shares beneath that figure, you are harming your shareholders. That's a truism. Now, the tough part of that, of course, is coming up with the intrinsic value. And, for example, a good example might be Coca-Cola. I think a number of people might have thought Coca-Cola was repurchasing shares at a very high price because they'll look at book value or PE ratios. But there's a lot more to intrinsic value than book value and PE ratios. And anytime anybody gives you some simplified formula for figuring it out, forget it. You have to understand the business. The people who understood that business well, the management, have understood and been very forthright about saying so over the years that by repurchasing their shares, they are adding to the value per share for remaining shareholders. And like I say, people who didn't understand Coca-Cola or who thought mechanistic methods of valuation should take precedence really misjudged the value to the Coca-Cola company of those repurchases. So we favor, when you have a wonderful business, we favor using funds that are generated at that business to make the business even more wonderful, and we favor repurchasing shares if those shares are below intrinsic value. And I would say that if it's a really wonderful business, we probably come up with higher intrinsic values than most people do. We have great respect, Charlie and I think it's developed over the years. We have enormous respect for the power of a really outstanding business, and we recognize how scarce they are. And if a management wishes to further intensify our ownership by repurchasing shares, we applaud. We just went over 8% of the Coca-Cola company probably in the last 3 or so months by a very tiny fraction. But we had a second purchase one time, but our percentage interest in the Coca-Cola company has gone up significantly through their repurchases, and we are better off because they have bought those shares at what looked like to some people perhaps high prices. And we thought they were wrong at the time, and I think now it's been indicated that or proven. So I urge you, if you're trying to decide on the wisdom of repurchases or of share issuances, that you don't think in terms of book value, you don't think in terms of specific PEs, you don't think in terms of any little model, but do you think in terms of what would you really, pick businesses you can understand, and then think what you really would pay to be in those businesses. And that's what counts over time, is whether the repurchases are made at a discount from that figure. And I would say with the companies that we own shares in, our interest in Geico went from 33 or so percent to 50% over a 15-year or so period, simply through repurchases, and we benefited significantly. So did every other shareholder, I might add, that stayed with the company, and we benefited in no way disproportionate to them. But that was a very wise action on their part. And there, too, they were all usually buying that stock at least double book value, and you could compare it to other insurance stocks and say, well, that's too much to pay. But GEICO wasn't an insurance company that was comparable to other insurance companies. It was a very different sort of business, and they were very wise, in my view, to be following that course of action. Charlie? No. Zone 3.
Oh, sorry. I'm Elaine Cohen from San Diego. I'm a little confused about how the B shares are going to be moving if they're 1/30th of the A shares when they get out on the market. Are they always going to be 1/30th of the A shares? And if they are, is that going to dilute the earnings of the A shares? Could you just explain?
Yeah, it won't dilute the earnings or value of the A shares as long as we use the money reasonably effectively that is produced. As I mentioned earlier, if it happens to be 1%, you'll own 1% less of all these other things. On the other hand, we'll have close to $400 million more of cash. So it will not, in our view, it will not dilute the value of the A. I expect over time that the B, a very large percentage of the time, will be selling very close to 1/30th, but it could sell for less than that ratio. It can't sell for any significant amount more than that ratio, or arbitrage will eat away at any slight premium. I think that takes care of that. Zone 4.
Mr. Buffett, my name is Hugh Stevenson. I'm a shareholder from Atlanta, Georgia. My question involves the company's interest in Wells Fargo. As you know, Wells Fargo, like most banks, has a very expensive branch system for deposit gathering and servicing their customers. As I guess you know, they also have moved more into branches in supermarkets and in online banking that seems to have the potential to very significantly reduce their costs relative to the branch system. Would you comment on how you think that might play out and how significant it might be?
Well, the question, you're right. Wells Fargo has been a leader in moving into supermarkets. They've got a couple different formats they've used, and they've certainly been a leader in the online banking services. Unfortunately, in banking, it's a little hard to have any secret formulas. Coca-Cola has 7X down there in the vaults of what used to be the trust company of Georgia, now SunTrust. But in the banking business, anything you do, your competitors can copy. Nevertheless, there is an advantage, and sometimes it can be quite a significant advantage in being first and learning more about different distribution methods. And I think Wells Fargo has done a terrific job in learning that. I think they've got some advantages, but they aren't advantages that other people can't work at copying and chipping away at. But it's a good management. They've done a very good job of seizing on that particular trend in supermarkets, and as such, they are a deposit gathering operation, and every other bank in the world will be looking, though, to see how that works, not only there but at other banks, to figure out whether they can copy it. Charlie? Okay. Zone 5.
My name is Alan Parso from Omaha. Berkshire has increased the rate of growth in its insurance float in excess of 20% a year since 1967. In regards to GEICO, its rate of growth, what is its historical rate of growth been in its insurance float, and what impact will it have on the rate of growth in the overall Berkshire insurance float?
Well, I would say that GEICO is a huge plus to Berkshire. Now, we owned 50% of it before. I mean, we've benefited from our GEICO investment in a big way ever since 1976. So it's not an entirely a new benefit that's coming in. We paid a good price for GEICO, but it is a terrific company. It has outstanding management. It has a low cost method of distribution, which is very difficult for people to. I mean, everybody wants to have that, but very few come close to it. The management is focused on bringing costs down even further and widening that competitive moat. GEICO, I personally think that just from what I see that Geico, I would think Geico's growth rate is likely to be greater, at least in the future that I can see, over where it has been in the past, but it's been perfectly satisfactory in the past. I think there are some advantages to it being part of Berkshire in that there are costs attached to bringing new business on the books, and we care not at all about reported quarterly earnings. Geico was relatively insensitive to those before, and that's a compliment when I say that, but they had some more pressure on them in respect to reported earnings than they will have as part of Berkshire, and I think there's some really big opportunities in terms of what can be done with Geico as part of Berkshire. So I think 5 years from now you'll be very happy with the fact that we own 100% of Geico, and I think you will see that as marvelous a company as Geico was independently, as an independent company, it will flourish maybe even a bit more as being part of Berkshire, not because we bring anything to the party. I mean, the management will continue to run it autonomously, but there are some advantages for it in being part of a larger enterprise. Zone 6.
Mr. Buffett, my name is Stephen Tuckner. I'm a shareholder from Toronto, Canada, and my question concerns the valuation of Berkshire shares. Given the large number and dollar size of the private businesses recorded at historic cost which Berkshire owns, shouldn't the multiple to book that the stock trades at essentially expand over time to reflect the increases in intrinsic value of the private holdings? And I cite Buffalo News on the books at essentially, I think, around zero, and even Geico now will be on the books at probably between $3 and $4 billion, worth more than that, as examples of the disparity between intrinsic value and book value.
Most of the businesses that we own, all of, or at least 80% of, are carried on the books at considerably less than they're now worth. And with some of them it's dramatic, although it's not dramatic compared to a $40 billion total market valuation for Berkshire. It's dramatic relative to the carrying price, because when we bought See's Candy for an effective $25 million in 1972, it was earning $4 million pre-tax. It earned over $50 million pre-tax last year. When we bought the Buffalo News, it was making nothing, paid 30 and a fraction million, and it's now earning maybe $45 million. And we've got a number of businesses, and Geico's worth more than we carry it for because of the accounting peculiarities of the first 50%. So it is true that overwhelmingly our businesses are worth something more than intrinsic value, than book value, and in many cases very substantially more, although that's reflected in the market price of our stock. I don't think you can go from year to year and trace the intrinsic value precisely by changes in book value. We use changes in book value as a very rough guide as to movement, and sometimes I comment. There have been certain annual reports where I've said our intrinsic values grew more than the proportional change in book value, and there's been others where I've said I thought it was roughly the same. So I don't think you can use it stick some multiplier on it and come up with a precise guide, a precise number. But I do think it's a guide to movement. Our insurance business, though, is the most dramatic case of dollar difference between book value and intrinsic value. I mean, the number has gotten very big over time there, and I personally think it will tend to get bigger because I think Geico will grow, and I think our other businesses will do well. The trick, of course, is to take the new capital as it comes along, and not from the issuance of the B, because that's relatively small compared to the amount of capital we will just generate from operations. Our float will grow from year to year, our earnings will be retained, and we've got to go out and find things to do that 3 or 5 years from now that people say, well, that's worth more than the book value, and that's a job. It's a tougher job than it was, but it's kind of fun. Zone 7.
Yes, my name is Jim Elliott. I'm from Minneapolis. I wonder if you could help me with an upside scenario. where the B shares, after they're issued, are limited and there's not a significant reissue afterwards. The A shareholders are somewhat reluctant to convert, and you have a run on the B shares where, let's say it goes to $2,000 a share. Do we then have the tail wagging the dog where the 2,000 command a $60,000 price on the A shares, and what does the this arbitrage take care of that, or what do we do in that case?
If there is demand for the B that pushes the price up somewhat, it will produce conversion from the A. I mean, the only way the B will be able to get, we'll just pick a figure, if it were to get to $1,200, there is no way that the A could be selling appreciably below $36,000. And I think that introducing the B into the equation will mean that there will be some people who like a lower denomination stock and come in, but it takes a lot of that to, in an appreciable way, affect $40 billion worth of what is now A stock. So, if there were incremental demand of $100 million a year or something like that, that's a little more than the demand that might otherwise go into the A. But I do not see it producing anything in the way of a big movement. But you're quite correct in that there's no way that the B stock can go up and not really force some conversion from the A. I think it'll be minor. Zone 8.
Hello, this is Rick Marliov from Oakland, California. I wanted to ask you about World Book Encyclopedia. World Book seems to me to be an example where Berkshire has invested in technology without necessarily intending to. I would expect that in 5 or 10 years it's going to be real tough to sell a paper encyclopedia, because at that time you'll probably be able to buy the computer and the electronic encyclopedia for less than the paper encyclopedia. Up till now, I haven't had the impression that World Book has been as aggressive as its competitors in marketing and developing its electronic product. It's been the highest price that I have seen of the competition. It asked at least a year ago, its list price was $600 and the competition was $80 to $100. You sold as low as $100 on special promotions, but I don't think that was the list. A year ago, you were still selling by direct sales. I have not yet seen it in a mass market software store. I've never seen it bundled with a computer. And I have seen one newspaper review of electronic encyclopedias that mentioned the World Book print version, but didn't seem to be aware that a World Book electronic version was available, which it was at that time. In terms of the product itself, we have both the World Book and the Groliers at our house. The Groliers came with a computer. And both encyclopedias in this last year solicited us to buy an upgrade. World Book was asking $85, Groliers was asking $30. But in addition, I ended up buying only the Groliers because it addressed my biggest disappointment on the original version of both of them, which was, it's sort of in a way, a minor issue, but I thought it was relevant for kids doing school reports. Neither one allows you to print out a very big percentage of the pictures in the encyclopedia. They have a lot of pictures, but you can't print them. And you can get a color inkjet printer for under $200 these days, so it's real practical to print things out. The World Book made no mention of having any improvement in this area. The Groliers said you can print out almost all the pictures, and I have found, since we got the upgrade, I found that to be true. So I'm concerned that I'm not an expert on this, but I don't think World Book is as aggressive in either developing or marketing its electronic encyclopedia. So my question is, do you plan to become aggressive in this area and a leader in the electronic technology, or have you considered selling your electronic business and just getting out of it?
Yeah, we won't sell the electronic business, that I can tell you. You're quite correct. Some of the technical stuff I'm not very good at. I have a little trouble turning on the light switch. But in terms of the bundled product, which is the encyclopedia that is offered with the purchase of a new computer, there's no question that that's become a large business in units. It's not so large in terms of dollars because those units bundled with an original equipment sale are very low. Actually, Encarta's probably, I'm sure, has sold many millions of units bundled with a new encyclopedia. It doesn't necessarily produce a lot of dollars, but it produces a lot of units out there. We at World Book, some of you may not have noticed, but Encyclopedia Britannica has within the last couple of weeks announced the cessation of direct distribution. Unit sales of encyclopedias, print encyclopedias in the country have gone down very significantly. In the last few years, as they have at World Book. We are in the process of changing and have already changed in some parts of the country the distribution system because we are going to see what can be made to work, if anything, in the direct distribution. There are some indications that we may be able to make money in that business, but with a different cost structure than before. We'll know more about that. We're not that far along because we changed the distribution system or partially changed it within the last few months. It's not easy to figure out how to make money in either the electronic or print encyclopedia end of the business. And we have some ideas in the electronic end that we'll know a lot more about in about 6 months or so, but I don't want to go into any detail on those at present. I've got the electronic product myself. It's a first-class product. We've got ideas about how to make it an even better product, and we have taken a lot of costs out of the print end of the business. We'll be putting some of those into the electronic end, but we've taken a lot of costs out of it. It may well be that it'll be a workable business for us, even though it isn't for anybody else, but the jury's still out on that. It is not the business it was 5 years ago, and I don't think it will be the business that it was 5 years ago because the world has changed in some ways on that. But we will not sell World Book. I'll state that unequivocally. We will not sell electronic World Book. We are in the business to stay, but we are groping a bit in terms of figuring out a configuration that will produce decent profits for us and sell a lot of World Books in the process. Charlie?
We don't have any way of avoiding declines in some of our businesses some of the time. Blue chip stamps once sold stamps at the rate of $120 million a year. Now it's about $200,000 a year. So we lose some.
We were in the windmill business many years ago. We try to make we think plenty about the problems, but there are industry problems. I was in anthracite coal at one time too at the street railways. I've seen them all. But World Book is a first-class product. It's a product I use, a product Charlie uses, and there is, through an electronic means, you can deliver information at costs far less than, unbelievably less than was the case not that many years ago, and the world in many forms will be adjusting to that, not just in encyclopedias, and it affects some of the businesses we're in, and it's something we think about, but it's very unlikely that Charlie and I are going to be smarter than the rest of the world in terms of the electronic world. We are looking at it as something where we're looking for the obvious and something that is within our capability of doing something about, but we're not trying to beat people at their own game where we're not very good at the game. Zone 1.
Mr. Buffett, Richard Charlton from Canada. One of the highlights for me in coming to the annual meeting for the past 7 or 8 years was the way that you dealt with the question that was inevitably asked by a new shareholder as to why you will not split your shares. I know how much it has meant to you to keep the shares trading in an exclusive way, and you have been my mentor for the last 17 years, and I think that what you're doing in splitting these shares in order to protect the public and indirectly Berkshire shareholders, but mostly to protect the public of your and Mr. Munger's tremendous integrity, and you're setting a fantastic example for corporate America, and I salute you, sir. Corporate America, and I salute you, sir. And I thank you very much.
Thank you. Thank you. Well, I hate to leave Zone 1 after that, but we'll go on to Zone 2. Thank you.
Wesley Jack from Oklahoma City, Oklahoma. As a stockbroker, I can say I definitely don't like UITs, and I appreciate your plan for the B shares. But as along with the rest of the shareholders, what we hope that the shares go up in value in the future, don't you see a problem with them coming back with this idea in the future?
On the unit, you mean on the issuance of unit trusts?
Yes.
I don't see any problem because the B will be out there, and it is a superior product, whatever its absolute merits may be. On a relative basis, it is a superior product to anything that is going to carry a big commission to a salesperson and a lot of annual costs. So I think my guess is we've taken care of that problem. I wish it hadn't come up, but I would think that it'd be very difficult for anyone to honestly offer a product, a derivative type product through a unit trust that would be superior to buying the product that will be available.
I think he's afraid that the B will go up to the place where the whole story comes again. And I must say that if that were to happen, we'd like it.
Well, we'd like it only if it reflected underlying values. But
yes.
Yeah, we have a very strange attitude on that. I mean, most managements feel that on the price of their shares that the higher the better, and that's an understandable feeling. But the trouble is the game isn't over at any time. We really feel the fairer the better. Our goal is that every shareholder participates in the progress that Berkshire makes as a business during their holding period. In other words, we don't want one party getting wealthy off the other. We want them to share based on the gain in value of the business. And to the extent that if the stock got way overvalued or way undervalued, that may make one party, in the first case the seller, in the second case the buyer, very happy. But there's somebody on the other side of the transaction. In economics, the most important question, maybe important beyond economics too, but when somebody tells you something, the first question to ask yourself is, and then what? And we tend to do that around Berkshire, and so the stock going up is not an end of itself, because the next question is and then what? And to the extent that the stock goes up because the intrinsic value goes up, everyone is getting their fair share of the pie as they go along. To the extent it exceeds that in some way, the selling shareholder gets a benefit, but the entering shareholder is at a disadvantage. And we really like the idea of the price tracking intrinsic value over time, and we think that by having the right kind of shareholders and by communicating with them properly and following the right kind of policies, that we can come as close to that as is attainable in a world where markets essentially are fairly volatile. And so far, I think it's worked out pretty well that way. But the intention is to, and the goal is to keep it that way. One thing to remember, in the end, the owners of businesses in aggregate cannot come out any way better than the businesses come out. I mean, the businesses are the and not just our business, I'm talking about all American business, the profitability of American business determines the profitability of what the owners of American business have. And you can forget all about the little ticker symbols and everything else. The owners suffer to the extent that they have some extra costs imposed in brokerage commissions, fees, all kinds of things. That diminishes the return from the business. But no one has figured out yet how to perpetually have owners do better than their businesses. And our idea is to have them do it as they go along in proportion to the gain that occurs during their tenure as a shareholder. And that isn't easy to do, and it's not attained perfectly, but that's the goal as we go along. Zone 3.
Morris Spence, and I have a serious question and then a less serious question. First, the less serious. You said that you and Charlie had lost between you 100 pounds. I was curious who had lost more.
No, I said the board had lost 100 pounds. I have some members of the board who would take umbrage at the fact that they weren't included in that total.
Okay. Who lost?
Charlie and I we're pretty close at the moment, aren't we? Modesty.
I must say you're both looking very good anyway. I was wondering who lost the most and what your diet secrets were. And then the more serious question was about float. You touched on this a little bit earlier, but you've often said that your insurance business is probably the most important business that you own. On page 12 of the annual report, you said, "We have benefited greatly to a degree that has not been generally understood because our liabilities have cost us very little." I was wondering if you could describe this a little bit better so we can understand it.
Yeah. Charlie and I have lost about the same amount, at about 20 pounds each. The insurance business provides us with float, and float is money that we hold that doesn't belong to us. It's like a bank having deposits. A bank has deposits. The money doesn't belong to it, but it holds the money. Now, when a bank holds deposits on everything except demand deposits, there's an explicit cost and interest rate attached to it. And then there are the costs of running the system and gathering the money, which is also must be attributed both to demand and time deposits. So there's a cost to getting what they would call deposits and we could call float. In the insurance business, a similar phenomenon takes place in that policyholders give us their money at the start of the policy period, and therefore we get the money paid in advance for the product. And secondly, it takes time to settle losses, particularly in the liability area. If you bang up a fender on your car, it's going to get settled very quickly. But if there's a complicated injury or something, it may take some years to settle. And during that period, we hold the money. So we have, in effect, something that is tantamount to the deposits of a bank. But whereas the deposits of a bank, it's quite easy to calculate the approximate costs. In the case of the float that the insurance company has, you don't really know what the cost of that float is until all your policies and losses, your policies have expired and your losses have all been settled. Well, that's forever in some cases. So you're only making an estimate as you go along of what that float is costing. To date, with Berkshire, in the 29 years we've been in the business, it appears, never certain, because you don't know for sure what's going to happen, but it appears that our float has not cost us anything on average. It's been years when we've had an underwriting loss when there's a cost. There's been years when we had an underwriting profit, and so we had a reverse cost. So we have obtained that float on very advantageous terms over the years. Far more, fully as important as that. It's important to get it at a low cost, in our case, no cost. But the other important thing is that we've grown it dramatically. And so we've gotten more and more money without having any cost attached to it. And if we still had our 16 or 17 million, I guess, of float that we had in 1967, and it was no cost, it would be very nice, but 17 million of free money is worth something, but it's not worth a ton. Having $7 billion, if we can achieve that as free money, it's worth a lot of money. And that growth has not probably generally been appreciated fully in connection with Berkshire, nor has the interplay of how having zero cost money in terms of affecting our gain in value over time. People have always looked at our asset side, but they haven't paid as much attention to the liability side. Charlie and I pay a lot of attention to that, and I mean it's not entirely an accident that the business is developed in this manner, and we have intentions of trying to make it to continue to develop in this manner and in that manner in the future. But we've got competitors out there too. Float per se is not a blessing. We can show you many insurance companies that thought it was wonderful to generate float, and they have lost so much money in underwriting that they'd be better off if they never heard of the insurance business. But the job is to get it in increasing quantities, but above all, get it cheap. And that's what we work at. And you do that in the business through having some kind of competitive advantages. You won't do it just by having an ordinary insurance company. The ordinary insurance company is not a good business. We have it in certain respects because of our attitude toward the business. We have it because of our financial strength gives us certain competitive advantages, and we have it in the case of GEICO because of a very low-cost operation. And it's up to us to try and figure out ways to maximize each one of those competitive advantages over time. We've built those advantages. I mean, in 1967, we were not looked at that way in the insurance business. We've built a position of competitive strengths, and in the case of GEICO, they had it without us, but we have bought into it over time. It's a very important asset, and you ought to pay a lot of attention over the years as to what is happening with that asset as to both growth and costs, and that will aid you in calculating intrinsic value. Charlie?
Nothing to add.
Okay. Is that Zone 4 is the next, Emily?
Henry Newhoff, shareholder, Dallas, Texas. My guess is that you consider the intrinsic value of the shares to be more than that represented by the price.
More than represented by what?
More than represented by the current price of the shares. If that be the case, what would be your thoughts about Berkshire repurchasing its own shares?
Yeah, no, we have said we do not consider Berkshire undervalued at this price. We didn't say we thought it was overvalued, but we said we did not consider it undervalued. So a repurchase based on our estimate would not be in the interests of shareholders. It's conceivable it could be at some time, but we do not think that's the case. We think intrinsic value far exceeds book value, but we do not think it exceeds present price. We're not selling any shares, though, either.